Well, this past week, the Federal Reserve decided to keep interest rates level and not make any more increases. But the question is, what does that mean for your hard-earned money? Stay tuned to the Retirement Income Source, where it's all about the income. And welcome to the Retirement Income Source, where it's all about the income. I'm David Scranton, here with Sarah Samuels. And today, we're talking about the Fed decision to stand pat with interest rates, what that means for the future, and most importantly, what you can do to take advantage of this when it comes to your hard-earned funds. Sarah, we haven't seen the short-term interest rates at this level in quite a long time. In fact, for 22 years, I want to say. So what grade were you in 22 years ago, Sarah? I need to torture myself for a moment.
I don't want to give away my age, but I think I was in probably fourth, fifth grade,
fourth grade, yeah,
that
that's right.
range.
Yeah, so you weren't paying attention to interest rates back then,
No, I
were
was
you?
too young.
Yeah.
No.
Interestingly, when I was really young, I remember interest rates, and maybe I was a little older than that, but because when I was that age, it was in the mid-late 70s. We had the oil crisis, and rates were double digits. Yep. So I just remember going into the bank with my mom and seeing the interest rates and seeing how crazy things were, and her making comments about, oh my goodness, I can get 10%, I can get 12%. So, either I was a really boring and dull kid, or maybe it's because the times I just caught my attention.
Well, I was going to say, Dave, you've always been a numbers guy, so it doesn't surprise me that you saw the numbers and you were intrigued by them. But I actually remember the 2007-2008 crisis more clearly because my father actually lost his job. So obviously, even as a kid, a younger person at that time, a teenager, actually, it impacted our family. So getting back to the Fed, though, the reason why they've been raising hikes, why we're seeing the highest hikes in over 2 decades, is really part of their battle against inflation, and
which they created, by the way.
That's a whole nother ball of wax,
right.
Of course. But again, it's all part of trying to bring down inflation. They mentioned they may even raise the quarter point near the end of the year, but they're kind of trying to take things slow. Do you think maybe they overcorrected too early, Dave, and that's why they've slowed down these hikes?
Well, time will tell. They kept interest rates low for a long, long time, and as a result, they created this inflation.
Yep.
Now they have to hike rates to slow down inflation. Yeah. And the question is, because there's such a lag effect, could be as much as a year or more lag between the time they raise a certain interest rate and the economy actually slows down and inflation starts to come down. It's anybody's guess, right? But what we do know, Sarah, is we're close to done with the cycle. What the Fed said on Wednesday was they're going to stand pat. They might look toward one more hike later this year. And, of course, they have to talk tough. They have to say that and let the markets know that could happen, because if they surprise the markets aren't happy, right? But I'm skeptical that's going to happen. I have a feeling that the rates may even stand pat going into the end of the year and into next year.
Yeah. Well, Dave, you mentioned your story about your mom when you were young being amazed at the rates she could actually get at the bank. And funnily enough, our next Ask Dave question has to do with something similar. So we have Arnold from Michigan. He says, Dave, I can get 5% or more on bank CDs for the first time in a while. So how long do you think this will last? And is there any catch?
Well, Arnold, there very well could be a catch, and I don't know how long it will last. But Arnold, if you look closely at the rates, you have short-term CDs that are paying a very high interest rate, but longer-term CDs that are not. So if you want to lock in that rate for 5 or 10 years, because we haven't seen those types of rates in literally since about 2000, 2001, then you can't do it. The longer-term rates are lower. So think about this. I can guarantee you a 5% interest rate for a month, right? Because I'm not paying you 5%. I'm only paying you about 0.4% for that 1 month, right? So that's easy. I can do that as what's called a teaser rate. And today, Arnold, there's a bunch of teaser rates out there with the banks. They're trying to get the assets. Why? Because the Federal Reserve interest rates are 5.25 to 5.5. So they could borrow money from the Fed at 5.25. They can pay you 5.25. They don't make any money on it, but their hope is they get your money there and then you keep it there. And even if the Fed ends up lowering rates, your money stays there. But here's the dirty little secret. Most people in the markets today believe that interest rates will come down in the next 2 years. And that's why right now, in government bond world, for example, a 2-year government bond is over 5% interest, whereas a 10-year government bond is about 4.3. Why? Because the suspicion is if you buy that 10-year bond, years 3 through 10 will be at a lower interest rate. That rates aren't going to stay this high forever. So right now, Arnold, bottom line, might be a time where you want to consider longer-term strategies and don't just get sucked into the short-term teaser rates.
Yeah. Well, Arnold, thank you so much for sending in your Ask Dave email. And if any of our listeners out there have a question, a retirement question, maybe a question about inflation or something you've seen recently and you want to ask Dave, all you have to do is email us at askdave@retirementincomesource. That's SOURCE.com. You're listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with Dave Scranton, and it is great to be with you all as we kind of cover what's gone on with the Federal Reserve in the past week, what we've seen with interest rates, and really what it means for you and how you can take advantage of the rates right now. Because Dave mentioned earlier, they're pretty much at or near the peak. That's what it looks like right now. The Fed funds rate is about 5.25% to 5.5%.
Right.
So Dave, let's talk about it. How can people right now take advantage if they haven't taken the opportunity yet to get in on these rates?
Well, first, I want to spend a little more time on the why, if we can.
Yeah, let's talk about the why first. Before we get to the good stuff.
I don't want to offend you. Are you okay with that?
I'm okay with that. Let's do it, Dave.
Because, and it goes back to the story with my mom.
Yeah.
Right about that era in the late 70s, early 80s, you were able to get 30-year government bonds at double-digit interest rates. But nobody wanted to do that because rates had been going up, through the late 70s into the early 80s. And sometimes people look at things through the rearview mirror, right? If rates are going down, people think, well, they're going to continue going down. If rates are going up, they're going to continue to go up. It's called recency bias. That's what psychologists call it. So back then, everybody thought, well, rates are going up. They're going up. I don't want to lock in for 30 years because rates are going up. So they bought short-term investments like short-term CDs or maybe T-bills. And the problem then is rates came down, and they only enjoyed that high rate for a short period of time. But Sarah, do you know back then, 1980, 81, looking back, what the best investment could have been that you could have purchased back then?
What would have been the best investment, Dave?
A 30-year bond. You could have locked in, and all the way through 2010 or 2011, you could have gotten double-digit interest rates if you bought a government bond with zero interest. And I'm not saying that rates are like they were back then. Back then, they were double digits. I don't think they're going to go that high. I very much doubt they're going to go anywhere near that high this time. Like I said, I think we're getting close to the peak of the Fed's rate hiking cycle. But it's still very much like that. That's a chance to lock into longer rates now while they're higher in a place that we haven't really seen in over 2 decades.
Gotcha. Okay. Well, I think that makes sense. And I think the main thing, though, is, how can people take advantage of it right now? Just buying those certain investments? Like, should they only look at those longer term investments right now?
Yeah. The people need to look longer term.
Yeah.
And if banks, Sarah, offered 10-year CDs at 5%, I'd say, okay, maybe that's a great option.
10-year.
But they don't.
Yeah.
But they don't. And it depends what you're doing here. If you've got money, like Arnold, right? If you've got money you're going to spend in 2 years or a year because you're going to make a down payment on a house, buy the CD. It's perfect. But if this is retirement money, you want to look longer term, right? So coming up, we're to discuss what options you might have for locking in that rate longer term, depending upon your personal situation, your risk tolerance, and lots of other factors. I'm David Scranton here with Sarah Samuels, and you're listening to the Retirement Income Source, where it's all about the income.
Welcome back to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with Dave Scranton. And earlier this week, the Federal Reserve decided to keep interest rates the same. They decided not to do any rate hikes. So this is a very important news item, but really it's more important for your retirement, especially if you're at or near retirement age right now. So far we've talked about what are some, we've seen some short-term investments with CDs, for example. We had a question about locking in those CDs and why it's a good idea or why it's not a good idea. And really, if you want something short-term, if you want to save, a couple years worth of money, a CD might be a good idea. But if you're saving for retirement, Probably not a good idea for a long-term investment. So, Dave, what are some long-term investments that you should lock in right now?
Well, the best example is when we talk about bonds, right? Again, in 1980 or 81, a 30-year Treasury bond would have been a great investment. You could lock in double-digit returns for all that time. It's a little different this time because, again, you get into a 10-year government bond and you're at maybe 4.3, 30-year government bond, somewhere in the same range, where short-term it's higher. So you're not getting double-digit interest rates right now because the market's anticipating rates are going to come back down, which is why the yield curve is still inverted, right? We always talk about this inverted yield curve where short-term rates are higher than long-term rates. But where you can get some opportunities here, assuming you have the propensity to take a little bit of risk, is with things like corporate bonds, right? Individual corporate bonds. Because corporate bonds pay more than government bonds. And in today's market, you can get some investment-grade corporate bonds if you know what you're doing. Let's say it's 6%. And they're still investment grade, so they're not like junk bonds or anything like that. But 6 is a lot better than 4, right? It's 50% additional retirement income. But the issue, of course, is buying individual bonds, Sarah, as you know, takes some work.
Yeah.
It's, you
it's specialized work, too. It's not for the faint of heart, essentially.
It's specialized work, right?
Yeah.
You have to do credit analysis on the particular companies that you're looking to buy, because companies, like we have a FICO score, credit score. Companies have a credit score. It's not called a FICO score. So you need to look at that. Then you need to look beyond that because, you know, we learned one thing in 2008 in the financial crisis. You can't trust the credit rating agencies. So it's a good starting point, but you have to look beyond that, right? But then you have to look at how long these bonds are. You've got to look at whether the bonds can be paid off early or not. That's an issue. Sometimes companies can pay them off early, which they might want to do. So you've got to be aware of that. So again, there's lots of factors that make investing in individual bonds maybe a little more complicated for people.
Yeah, you even need to know with the company.
Especially when it comes to corporate bonds.
Right. You even need to know when the company is, where it is in its cycle even, right, Dave? If it's going up or if it's going down, it's hard to see a snapshot.
And the debt repayments, okay, are you the first tranche of debt that has to get repaid or the fifth, you know? So, again, lots of factors there. You know, you want to be, if I have a first mortgage on your house and I'm a creditor, I'm in a better position than the person who's got the third mortgage on your house, right?
Exactly.
Same
You're going to get paid first.
And same thing is true with bonds.
Absolutely. Well, Dave, I don't want to upset you. I know it's very early in the show, but our next question has to do with one of your least favorite items that get brought up, and that's bond funds. So,
oh boy.
We have a question from Sheila in Louisiana, and Sheila says, are bond funds a better long-term alternative? Sheila must be a new listener of the show because she would know not so much.
Yeah. Well, I have to admit, my blood pressure is still borderline, but I think I'm okay now with this mention of bond funds. The reason because Sheila sounds like a very nice lady, so Sheila, I'm not upset with you. But yeah, actually went to the doctor. It was really interesting because I had a pretty high reading, and I explained to the nurse that, you know, part of it is that, you know, there for my physical, that, you know, any man, some of you gentlemen listening can relate to this, that, you know, when you know the doctor is going to be standing behind you, snapping his glove, his latex glove, that makes your blood pressure go high. So she then reassured me that he did that 6 months ago. He's not going to do that today. I had to retake my blood pressure, and it was actually down 13 points on top and 6 points on the diastolic. So, yeah.
That was the cause.
Yeah, kind of interesting, yeah. And because the nurse didn't mention bond fund, Sheila. So here's the simple answer. The simple answer is that if you have, let's say, less than $250,000 to invest in the bond market, then maybe bond funds are okay, right? Because you need to diversify cost effectively. But if you have over $250 to invest in the bond market, you're much better with individual bonds. Why? Because if your goal is to lock in today's higher rates, you can't do that with bond funds. You can do it with individual bonds. And Sheila, the reason a lot of people buy individual bonds that are retired or close to retirement is they want two guarantees. They want, number one, a guaranteed level interest payment for the life of the bond. And number two, they want to know that when that bond matures, they're going to get the full face value back, assuming the company hasn't gone bankrupt. But Sheila, guess what? If you own bond funds, both those guarantees are off the table. Why? Because when you own a bond fund, you don't own the bonds. What you own is the stock of a company that owns bonds. It even sounds riskier. So again, if you're a small investor, you might be stuck with that. But if you've accumulated more than $250,000, I encourage you to look at individual issues. But again, you might want to be careful. Don't try this at home.
Yeah. And Sheila, I hope you learned your lesson. Don't ever send us a question mentioning bond funds. No, I'm just kidding. We love your retirement questions. Please keep them coming. You can always shoot us an email at askdave@retirementincomesource. That's SOURCE.com. You're listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with Dave Scranton. Today we're talking about long-term investments. The Fed made some news recently when they decided to keep interest rates the same. They decided not to hike them, but they are already pretty high up there, looking like 5.25% to 5.5%. So overall, Dave, it's a good chance right now for people to. It's a good time actually for them to lock in some of these long-term investments.
I believe so, unless something crazy happens.
Right, unless something crazy happens, which it could happen. But specifically bonds, we've spent a lot of time talking about bonds and why it can be so difficult to know which bonds to invest in. So if it's hard to know which bonds to invest in specifically, and bond funds maybe aren't the greatest idea and they're only in certain situations, what should people do? How should people invest in bonds?
Well, look, if you're a do-it-yourself investor and you have a little bit of experience with bonds and you're pretty sharp and you're good at math and you have the time and wherewithal, maybe you could do it yourself.
Yeah.
Most people want to go to an income specialist because it takes more work. Now, before, years ago, you can always go and say, okay, I want bonds that are in this maturity rate period, maybe 10 to 15 years, for example. I want something that is investment grade and they can trust it. But like we said, we found out during the financial crisis, the movie The Big Short, right?
Yep.
When they walked into the rating agency and the lady looked at them and said, how can you still have these mortgage bonds rated AAA when we know people are defaulting on their mortgages? And she looked at him and said, well, the reason is because we can't, I've got to give them a AAA rating. I've got to pay my bills. If I don't give it to them, they'll go to the rating agency next door and they'll get it, right? So we learned 15 years ago you can't necessarily trust the rating agency. So you've got to be really good with math. You got to know how to look at the financials of a company. So you have to look at the income statements, right? Profit and loss. You have to look at the cash flow statements because cash flow and income is different. The balance sheets, right? One thing we learned 3 years ago when we shut down the whole economy is how important the balance sheet is with bonds, right? If a company can't sell any products for 6 or 12 months and they don't want to lay off all their employees, what can they do, right? How long can they live off the cash on their balance sheet or any lines of credit they could tap into? So balance sheet's important, right? Then you have to know these other features, right? Remember we talked about what if the company can pay it back early? That's a call option, right? You can always pay off a loan early you have with the bank, right?
That's true, right? They don't get mad if you show up early with all your money and pay off the loan.
That's right. And with bonds, the good news is there are some where you can't pay it off early. There are some where you can, some where you can't. So you want to know the difference, right? Obviously, if a company reserves the right to pay it off early, they're going to pay a little more interest for that right. But then it means that, if interest rates drop, they're going to want to pay it off early and refinance it, and you're stuck with your principal back. So you're really not locking in a longer interest rate. So I would stay away from callable bonds at this particular stage. But then, like I said, you want to look at, okay, are they secured? Are these bonds secured by any property, any equipment at the company? Or are they completely unsecured, right? Something you have to look at there. Then also, when you buy the bonds, how do you buy them? Because bonds aren't bought like stocks. They're actually negotiated, right? So you have to go to your clearinghouse, wherever you make these trades to, and you have to buy it. So again, a lot of moving parts.
Yep. Well, there are a lot of other investments out there. It's not just bonds that are where you can lock in these higher rates of interest. So we're going to talk about some other investments, some other ways you could take advantage of the opportunity right now and lock in those higher rates. I'm Sarah Samuels here with Dave Scranton, and you're listening to the Retirement Income Source, where it's all about the income. Welcome back to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with Dave Scranton, and thank you for joining today's show as we're talking about ways that you could take advantage of the current high interest rate environment. Now, the Fed recently decided they were going to keep interest rates the same, but this has all been part of their battle against fighting the inflation that, as Dave argues, they cause. So it's all part of that battle. But so far, we've talked about one of the ways you could take advantage, and that's investing in bonds. We've discussed why bond funds are not the same as bonds, so you don't ever want to get those two confused. And we've talked a little bit about why CDs are really only a good investment if you're looking for something short term, maybe money to spend in a few years, versus when you're planning for retirement, you're looking at 30 years or more. So those CDs are not really a great option. So, Dave, what are some other ways that people can take advantage of this high interest rate environment that we're currently in, besides investing in bonds?
Yeah, and the reason we're talking about bonds and instruments like that is because you could be in high dividend stocks, but you're not really locking in the interest rate, right? It's a little bit of a different story. With high dividend stocks, you lock in the interest rate when there's a bear market and the stock price dives and now the dividend looks higher, right? Yep. But bonds are one way to lock in the yield. But another way is their kissing cousin, as I like to call it, the preferred stock. Okay.
Okay, preferreds. I've heard about these before.
Oh, I know we've talked about them right here.
Yeah.
And preferred stocks are interesting instruments because although they're considered a stock, they're actually more bond-like than they are stock-like, right? Because, they have a fixed interest rate they call a dividend, right? That rate is usually a little higher than an equivalent bond.
Right.
They also have a par value like a bond. So when they get redeemed at that par value, right? So, and they tend to fluctuate a little bit with the bond market and stock market, but a little bit more with the bond market than the stock market. So again, they're actually more bond-like than they are stock-like. So why are they considered a class of stock? Well, because they typically go on perpetually. In other words, if the company doesn't choose to pay them off and refinance them, they go on forever, like stocks do, whereas bonds mature at a specific date. And that's why, Sarah, you earn a higher dividend rate in preferreds than you do in interest rate in bonds, because there's no fixed maturity date where you're going to get your money back.
Yep. And I know we have talked about those preferreds before, and I think we had a whole show about the stock-like bonds and the bond-like stocks, if it's not already confusing enough, but there's a lot of different investments, and they all operate in different ways. But Dave, let's get into our Ask Dave question, because it's about preferred stocks. Our question is from Michael. He's out in California. He said, my dad had preferred stocks, and he always seemed to like them, but how do I know which ones to buy?
Well, Michael, great question. Because you're like most financial advisors out there, where you just don't know which bonds or preferreds to buy, so you buy bond mutual funds. In the case of preferreds, there really aren't any preferred mutual funds, so most advisors stay away from preferreds because they have to pick individual issues. So how do you know what to buy? Well, it's much like the conversation we just had with bonds, right? So the first thing is preferreds have a FICO score, an equivalent of a FICO score that you might have, depending upon your credit rating, right? So they have their own credit ratings with different agencies. So the first thing is you filter for the credit ratings. But then you want to look at their financials, just like with a bond. And frankly, you want to look at the financials. The analysis you do in determining, which preferreds to buy is much more like your analysis you do in determining what bonds to buy than compared to if you're trying to pick stocks, okay? So now you're looking at the financials, okay? You also have the callability problem, okay? So that they can refinance these early. So you want to be careful, because if it's callable and interest rates drop, right, in a lower interest rate environment, that's when they're going to want to pay off the high interest, high dividend rate preferred and try to refinance at a lower rate. So here you think you're locking in the rate, you're not. So the real way to lock in the rate is to say, I'm going to get a non-callable investment. So that's important. But you also want to be careful, because most preferreds are issued by financial companies, right? So you're going to be overweighted in financials. So you want to try to find the best preferreds that aren't financials, but then you also want to take the financials, I believe, with the companies that are too big to fail. In fact, Sarah, as you know, back in 2008, I had a lot of people in preferreds, and I'm grateful to say that we didn't have one default even during the financial crisis, and part of it was because I picked companies I knew were too big to fail. So if you pick those bigger financial institutions, that gives you another level of protection. So I hope that helps on how to pick preferreds.
Yep, there's a lot of that goes into it. So if you have a question about any of the investments maybe that Dave mentioned or some other retirement concepts, all you have to do to send us your question is send us an email. Ask Dave at Retirement Income Source. That's SOURCE retirementanswer.com. Thank you for listening to us right here on the Retirement Income Source, where it is all about the income. We've been talking about the recent news with the Fed deciding to keep interest rates about the same, and really what that means for you and ways you could take advantage of this existing high interest rate environment. It looks like they're probably at the peak of where the interest rates are at or nearing
That's
the
right.
peak.
They're very close, yeah.
Yeah, very close. So Dave, you mentioned earlier about diversification, and that if you choose during the Ask Dave question when you're answering that, if you might be overweighted in finance companies if you're a do-it-yourself investor. So how does diversification play a role in this? Like, obviously you shouldn't invest in only one thing, but what should you really consider when it comes to diversifying your investments?
Depending upon your risk tolerance level, in general terms, you want to have a balance with some stocks and some bonds, right? Now, that balance depends upon the amount of income. It depends upon how much of your income you want contractual, and things like bonds and preferreds, versus things that you want that you don't care if the income's contractual, like stocks, right? So it depends upon how much income you need. Because bonds and preferreds tend to pay more than common stocks in terms of an income stream, and how much you want, you want consistent versus ability to fluctuate. But then also how much your risk tolerance level is. You got to think about, not now what happened in 2008 when you were working, when you saw your accounts drop by half, right? Because you're working back then, it's a different game. But now that you're retired, or if you're going to be retired, you have to think about, okay, I'm retired, I've saved $1 million. I open up my statement and it drops to 500,000. How's it going to make me feel? Am I even going to be able to enjoy the money that I'm getting from Social Security, pensions, and other sources? And what if it drops to 750 instead? How does that make me feel? And you got to figure out what the greatest level is to which you're willing to let your investments drop in retirement. And it could be $1 million goes to 900. It could be $1 million goes down to 800, right? Then you could back into your stock bond allocation, because the stock portion could drop by half, right? And we know that because it happened twice in this century, right? And Sarah, the fact that it happened twice tells us it can what?
It's probably going to happen again.
It certainly can happen again.
Yeah.
That's right. So those are the factors that go into, your stock bond allocation. But then within each category, you want to be diversified, right? So within your bonds, you want to be diversified across industries, right? So of course there are 10 different sectors. You probably want to own at least 7 or 8, right? Stocks, same thing. Even if you're trying to, be cute and trying to outperform the market, so you don't want to be in underperforming sectors. You don't want to be in 2 sectors. That's too risky. You probably want to be in at least, 6, 7 sectors, right? We talked about preferreds. If you're going to be in preferreds, try to find some non-financial preferreds so you're not in all financials, okay? So again, just some things that you need to think about when it comes to diversification.
Yep. Well, Dave, I think that a lot of people too, some people get caught up in what they hear. Maybe they hear news from their financial advisor, or maybe they hear from their friend, right, who's invested in the latest thing or the latest fad stock.
Lot, sure.
Right. And then, especially, I don't want to insult anyone, but sometimes men maybe get a little competitive, so they want to make sure they're...
You're insulting me, that's for sure. I get
They
it.
want to make sure they're getting the most money. So how do people really combat that, just real quickly, when it comes to the psychological aspect of making sure you're not missing out?
Yeah. FOMO. You're talking
exactly.
about FOMO. Fear of missing out.
Exactly.
Well, the simple answer is this is where you might need a coach. A good advisor is a good coach. Think about it. If you're an athlete, right, you could be up in a basketball game by 20 points with a minute left, and you want to start shooting up 3-pointers. You want to win by 30 or 40 points, right? But the coach is there to say, whoa, whoa, whoa. Hold on the ball, run out the clock, no turnovers. If I see somebody launching up a 3-pointer, I'm going to pull you out of the game, right? So sometimes you need a coach to be the voice of reason.
Yep.
And that's where a good income specialist can often be that voice of reason for that do-it-yourself investor who's very offensively minded, very aggressive, and trying to make this paradigm shift to an income-first, growth-second mentality.
Yep, you need someone to pull you back a little bit. So the reason why we're seeing the Fed raising interest rates and now holding them steady, at least in the most recent meeting, the reason they did this was, of course, to tackle inflation. And as we know, inflation is one of those silent retirement killers. So we're going to talk about ways that you can help battle inflation, where Dave thinks it's going to go next. I'm Sarah Samuels here with Dave Scranton, and you're listening to the Retirement Income Source, where it's all about the income.
And welcome back to the Retirement Income Source, where it's all about the income. I'm David Scranton here with Sarah Samuels. And today, we're focusing on the recent Federal Reserve news where they've halted on raising interest rates. They're threatening to raise one more time. I'm not sure I believe them, Sarah.
Tough talk.
But bottom line is we've seen interest rates right now that are the highest they've been, short-term rates, in 22 years. So far, we've discussed various ways that you can lock in those rates, right? We talked about bonds and the do's and don'ts of bonds, preferreds, the do's and don'ts in preferreds, right? So again, the importance of locking in the higher rate today versus taking a short-term teaser rate in a bank and then having the rug get pulled out from beneath you.
Right. Plus, we talked a little bit about diversification and what that means for your portfolio overall, and the dangers of really not being diversified, and plus how to manage your risk tolerance and really how that affects your investment strategy. So, Dave, we know that there's a lot of different types of people out there, and a lot of people have different investment strategies. But what if you have someone who is an extremely conservative investor? They're the kind of person everything makes them very nervous. Like imagine the Chihuahua just sitting there shaking, right? That kind of person, very conservative. What are some things that they might be interested in investing in?
So they're really a CD person is what you're saying.
They might be a CD person. Is that what they should invest in,
As much
though?
as diversification could lower the risk, it doesn't lower the risk enough for them, right?
Yep.
So for some of those people, we don't talk about this a lot on the show, but one of the things could be a fixed annuity with an insurance company. Annuities are the good, the bad, and the ugly, right? We always talk about how you have
We
to
actually
be
have a
careful.
show on that if you
That's
want
right.
to listen
We
to
did
it
recently.
on our retirement income source radio show.com.
Yeah, and you got to be careful of certain types of annuities, but fixed annuities are really simple. It's like the bank's it's like the insurance company's answer to a bank CD, right, where they pay a fixed interest rate. And this is no different from if you have a fixed account in a 401k with a larger company. How do they pay you that fixed rate of interest? Typically, they buy GICs, guaranteed investment contracts. What are GICs? They're CD-type instruments offered by an insurance company, right? So the insurance company can get usually a higher rate for longer, right? So a fixed annuity is a great way that an individual listener can get a fixed interest rate for longer. Why longer? Because insurance companies can invest differently from banks, right? Banks are going to be borrowing that money from the Federal Reserve at today's short-term rate, so they know they get it 5.25 today. They'll pay you 5.25, but they're not going to guarantee you 5.25 for 10 years. But insurance companies raise capital differently, and therefore they can often pay those higher rates for a longer period. So, Sarah, to answer your question, for somebody who's that conservative, the Chihuahua image, which I hate to say that because I know some of our listeners are that conservative, and I hope we didn't insult. I hope you didn't insult anybody. Usually I'm the one who insults people. This time I think you may have. But bottom line is I think the fixed annuity is the only thing I could think of that's really that secure but can still lock in the rate longer term.
Well, I think it's important for everyone to know all the different investments based off your risk tolerance. If you have zero risk tolerance, and those people are out there. But the main point really, Dave, is inflation. And that's another huge thing. We've talked about inflation. We've talked about how it's the retirement killer on past shows.
That's a whole other can of worms.
That's a whole other can of worms. We know right now we're in a pretty high inflation environment. We were told it was transitory. It doesn't seem to be. But our next Ask Dave question has to do with this. So we have Matthew from Virginia, and he says, how can I hedge against high inflation inside my retirement portfolio? What should I invest in?
So, Matthew, the challenge here is it's difficult to hedge against high inflation and lock in today's higher rates at the same time. Now, the exception to that comment, Matthew, is if you're going to be retired and you've saved enough money where you're not going to take all of your income. So let's say you can generate 6% on your portfolio, interest and dividends, and the types of things we talked about, right? If that's the case, then if you only need 3%, well, you can reinvest that other 3% and create an organic inflation hedge. So, Matthew, we call that growing your money the old-fashioned way by the reinvesting of interest and dividends, right? But let's say that that's not the case. Either you haven't saved enough, you need all the income in retirement in the early years, or maybe you just want all the income, right? Well, then you're not going to be able to lock it in. So then you're looking at things like that are more common stock oriented, right? Whether you're in high dividend stock strategies, right? Perhaps you can knock down a dividend of more than 4% in a high dividend stock strategy. Or you get into business development companies, BDCs, or REITs. Both BDCs and REITs are what I call and you mentioned this term earlier, Sarah, a bond-like stock, because BDCs make loans to companies, and those loans are like bonds. So when you own a BDC, you own the stock of a company that owns bonds, like a bond fund, but you typically get higher yields, and a lot of those loans are variable rate. So in high inflationary environments, the yield that gets passed down to you goes up. Real estate investment trusts, same thing, right? Because you're investing in real estate and you're getting flow through of the rental income to you in high inflationary environments. That rental income often goes up faster, right? So unfortunately, Matthew, if you want an inflation hedge, unless you've done a great job and don't need all your income in the early years of retirement, you're going to have to forego locking in the rates today in exchange for possibly a higher rate down the road. So it's kind of like you got to make the decision, pay me now or pay me later. But in most cases, you can't get both.
Can't have your cake and eat it too, right? Matthew, thank you so much for sending in your Ask Dave question. And if any of our listeners or YouTube viewers out there have a retirement question that you would like Dave to answer, maybe even on a future show, all you have to do is send us an email to askdave@retirementincomesource. That's SOURCE.com. Thank you for spending your weekend here with us on the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with Dave Scranton, and we're talking about some recent news this week from the Federal Reserve halting the interest rate hikes. Last hike, I believe, was back in July, so they decided not to raise interest rates. But really, the reason why they started rates is their goal was to tackle inflation. And inflation not only affects those that are still working and earning a paycheck, but it really hits those in retirement the hardest. So, Dave, we talked about ways you can hedge against it, sort of, even though you can't have your cake and eat it too, inside of your portfolio. But what are other ways people can hedge against inflation in retirement?
It's funny you mentioned before I answer that, you mentioned the news. Well, really non-news. We always knew the Fed wasn't going to raise rates this time. We've known it for a few weeks. Yeah. But it's not about that. It's about what the Fed says afterward, because the Fed said, they're going to try to make one more hike later in the year. The markets on Wednesday reacted adversely, right? After the news, markets were flat all day, and after the news, they dropped. So, the Fed can move markets.
Yeah.
So, what was your question? I forgot your question already. Sorry.
I'm sorry, Dave.
I guess I'm getting older.
Hey, I was asking about inflation, because we talked about ways, you can do things inside of your portfolio. But what are some other ways in retirement that you can hedge against inflation? Because you're planning for 30 years or more nowadays.
And I love some of those instruments I mentioned. Yeah. I really do, because high dividend common stocks, over time in a high inflationary environment, companies can charge more for the goods and services, and they could pass that through in an elevated dividend. I mentioned BDCs, business development companies. A lot of the loans in those companies that they make to medium-sized corporations are variable rate, so in higher interest rates environment, there's a higher interest rate that can pass through. Real estate investment trusts, same thing. The rental income on some of the properties goes up faster. So I love all those things, but they don't lock in the rate. But the answer, like most things in life, is, ignore the extremes. Should you be in all bonds and preferreds? For most people, no. Should you be in all common stocks in or near retirement? Definitely not for almost everybody, right? But there's a balance. And again, how do you strike that balance? You say, okay, how much money do I need in retirement? And how much money do I want in retirement? So the I need is to live the same lifestyle I have today while I'm working. Then the I want goal is, okay, now that I'm going to have more time on my hands, more time means I'm going to do more things means I'm going to spend more money. How much extra income do I want over my needs now to have an enjoyable retirement? And then back into it and say, okay, what allocations can I have with this income need? And make a personal choice. A lot of people that say, okay, for my I need goals, I want those funded through Social Security, pension, I want them funded through contractual things like bonds and preferreds. But for the extra I need goals, that extra, well, we could do REITs and BDCs and common stocks. Because if dividends ever get cut, well, it's not cutting into the bone. I can still pay my utilities, right? My property tax, my insurance. So those are the things that go into that decision for the most part. And again, you can't forget, Sarah, that can I sleep at night? You got to close your eyes and envision, what is it like if I'm retired? If I gave up my job, gave up my paycheck, and now if I open up my statement, how far down can that account balance go before it starts to affect me emotionally, where I can't even enjoy the income I'm getting from other sources? Because nobody wants to retire and be miserable and stressed out every day about money.
Yeah, what's the point in that? You worked your whole life. You should be able to enjoy your retirement. Well, we hope you enjoyed this episode of the Retirement Income Source. And if you want to listen again, maybe send out to your friends or family. All you have to do is go to retirementincomesourceradioshow.com and listen to all our past episodes there.
We love it if you do that. But what we love even more is if you join us next week right here. Same time, same station. I'm David Scranton, here with Sarah Samuels, and you're listening to the Retirement Income Source, where it's all about the income.